If you have more than $250,000 saved in a traditional IRA or 401k, the IRS has a plan for your money. And most people with this much saved have no idea what is coming. In 2026, a major tax change is scheduled to take effect. It could cost you tens of thousands of dollars in retirement if you do nothing before the deadline. This is not a scare tactic. This is not speculation. The numbers are written into the tax code right now, and the clock is already ticking. Here's what very few financial advisors are telling their clients. The tax cuts passed in 2017 under the Tax Cuts and Jobs Act are set to expire at the end of 2025. When they expire, federal income tax rates go back up automatically. For many retirees, that means the money you pull from your IRA or 401k in 2026 and beyond will be taxed at a significantly higher rate than it is today. The 22% bracket you might be in right now could jump to 25%. The 24% bracket could jump to 28%. And if you are in the 32% bracket, you could be looking at 33% or higher. That may not sound like much. But on a $50,000 withdrawal from your retirement account, that difference could cost you an extra $3,000 or more in taxes every single year, and it gets worse. If you have over $250,000 in a traditional retirement account, the IRS requires you to take money out starting at age 73. These are called required minimum distributions, or RMDs. You cannot leave the money alone. The government forces you to withdraw it, and every dollar you withdraw is taxed as ordinary income. In 2026, that income will be taxed at the new higher rates. This combination, forced withdrawals plus rising tax rates, is quietly draining retirement accounts across the country. But here's the good news. If you act before the end of 2025, you still have time to protect yourself. There are proven legal strategies that seniors just like you are using right now to lock in today's lower tax rates before they disappear. And that is exactly what we are going to cover today, step by step. If this is your first time here, please subscribe to this channel right now and hit the notification bell. We publish time-sensitive information about taxes, Social Security, Medicare, and government benefits specifically for people in or near retirement. Many of our viewers have told us they almost missed an important deadline because they did not have notifications turned on. Do not let that happen to you. Subscribe and turn on the bell. It takes 5 seconds and it could save you thousands. Now let us talk about why this problem exists and why it catches so many people off guard. When you put money into a traditional IRA or 401k during your working years, you got a tax deduction. That felt great at the time. But there was a catch written in the fine print. Every dollar you put in was a loan from the IRS. You did not pay taxes then. But you will pay taxes later when you pull the money out. And the IRS gets to decide what the tax rate is when you pull it out. For decades, people were told that they would be in a lower tax bracket in retirement. That assumption made sense when it was made. But today, millions of retirees are finding out it is not true. Why? Because many people retire with more saved than expected. They have Social Security income on top of their withdrawals. They may have pension payments, rental income, or investment dividends. All of that income stacks on top of your IRA withdrawals. Before you know it, you are in a higher bracket than you were while you were working. This is what the IRS calls the tax torpedo. It is the moment when your retirement income pushes you into a bracket that triggers higher taxes, higher Medicare premiums, and even causes more of your Social Security to become taxable. Up to 85% of your Social Security benefit can become subject to federal income tax once your combined income crosses $34,000 for a single filer or $44,000 for a married couple. Let us put real numbers on this. Imagine a retired couple. They receive $28,000 per year from Social Security. They also take $40,000 per year from their traditional IRA to cover living expenses. Their combined income is $68,000. Because that number exceeds $44,000, up to 85% of their Social Security, which is $23,800, becomes taxable. They are now paying taxes on income they thought was largely protected, and beginning in 2026, they will pay those taxes at a higher rate. The worst part is that the IRS does not send you a warning letter. They do not call you. There is no notification that says your tax situation is about to get more expensive. You simply file your return, pay the bill, and wonder where the money went. If this sounds familiar, if you are nodding your head right now because this is your situation, please take a moment to like this video. It tells us that this information is reaching the right people. And leave a comment below. Tell us roughly how much you have saved in retirement accounts, or just say hello. We read every comment, and your questions help us make better videos for you. So what can you do about this? The single most powerful tool available to you right now is called a Roth conversion. A Roth conversion is the process of moving money from your traditional IRA or 401k into a Roth IRA. You pay taxes on the amount you convert today at today's rates. Then that money grows completely tax-free. And when you pull it out in retirement, you pay zero taxes on it. None. Here is why this is so powerful right now. Today's tax rates are at historically low levels. We know for a fact that rates are scheduled to rise in 2026. That means 2024 and 2025 are your last chance to convert money at current rates. You are essentially buying your tax-free future at a discount. Let us look at a simple example. Suppose you have $300,000 in a traditional IRA. You are 65 years old, married, and your taxable income is currently $60,000 per year. You are in the 22% federal tax bracket. If you convert $30,000 this year into a Roth IRA, you will owe approximately $6,600 in federal taxes on that conversion. That stings a little, but that $30,000 will now grow tax-free for the rest of your life. When you pull it out at 75 or 80, you pay nothing. Compare that to leaving it in the traditional IRA. At 73, the IRS forces you to start taking distributions. In 2026 and beyond, those distributions will be taxed at higher rates. You could end up paying 25% or more on every dollar you are forced to withdraw. The key to a smart Roth conversion is not to convert everything at once. That would push you into a very high bracket and trigger a massive tax bill. Instead, you convert strategically, a little each year, to fill up your current tax bracket without crossing into the next one. A qualified tax professional or fee-only financial advisor can help you calculate the right amount to convert each year. You can also use the IRS withholding calculator at irs.gov to get a rough sense of where you stand. To open a Roth IRA, you can contact any major brokerage, including Fidelity, Vanguard, Charles Schwab, or your existing bank. You can also call the IRS helpline at 1-8008-29104. Oh, if you have questions about whether a Roth conversion is right for your specific situation. If someone in your life, a parent, a sibling, a neighbor, a friend approaching retirement, could benefit from knowing this, please share this video with them right now. You can send it through text, email, or social media. Sharing takes 10 seconds and could save them thousands of dollars. The deadline is real and the clock is running. Beyond Roth conversions, there are two other strategies worth understanding. The first is called a qualified charitable distribution, or QCD. The second involves careful timing of your Social Security claiming decision. A QCD allows people who are 70 and a half or older to donate money directly from their IRA to a qualified charity. The amount you donate, up to $105,000 in 2024, counts toward your required minimum distribution, but is not included in your taxable income. That means you satisfy the IRS requirement to withdraw from your IRA without adding that money to your tax bill. Here's a real-life example of how powerful this can be. Consider a 74-year-old widow named Helen. She attends church regularly and donates about $10,000 per year. She used to donate from her checking account, which gave her a charitable deduction on her taxes. But once she switched to a QCD and started donating directly from her IRA, that $10,000 never appeared on her tax return as income at all. That kept her total income lower, which kept her Medicare Part B premium lower, and also kept more of her Social Security out of the taxable zone. One simple change, multiple benefits. To set up a QCD, contact your IRA custodian, the bank or brokerage that holds your account. Ask them to send a check directly to your chosen charity. The check must go to the charity, not to you. The IRS is very specific about this. Make sure your charity is a qualified 501(c)(3) organization. Most churches, hospitals, and established nonprofits qualify. The charity will provide you a written acknowledgement, which you should keep with your tax records. If you are not yet subscribed to this channel, this is a great moment to do it. It is completely free. Just click the subscribe button below this video. We release new content regularly on topics like this, including Social Security timing strategies, Medicare cost reduction, tax-saving tools for retirees, and much more. New subscribers tell us they wish they had found this channel sooner. Do not wait. Now let us talk about Social Security timing, because this decision alone can save or cost you tens of thousands of dollars over your lifetime. You can begin collecting Social Security as early as age 62, but if you do, your benefit is permanently reduced. How much? For someone whose full retirement age is 67, claiming at 62 means accepting a benefit that is 30% smaller for life. On a $2,000 per month benefit, that is $600 per month less, every month, for as long as you live. On the other hand, if you delay claiming past your full retirement age, your benefit grows by 8% per year until age 70. That means someone who waits until 70 instead of 67 could receive 24% more per month for life. On that same $2,000 benefit, waiting until 70 gives you $2,480 per month instead. That is an extra $5,760 per year. And because Social Security benefits include annual cost of living adjustments, a higher base benefit compounds over time. But here is where the tax strategy connects. If you delay Social Security and use IRA withdrawals to live on in the meantime, you are also creating a window to do Roth conversions. While your income is lower before Social Security kicks in, you can convert larger amounts at a lower tax rate. Then when you start collecting Social Security at a higher rate, your IRA balance is smaller, your RMDs are smaller, and less of your Social Security gets taxed. This is called a tax planning bridge strategy. And for the right person, it can save six figures over a 20 to 30-year retirement. The Social Security Administration offers a free tool at ssa.gov called the Retirement Estimator. You can enter your birth date and earnings history to see projected benefits at different claiming ages. You can also call the Social Security Administration directly at 1-800-772-1213 to speak with a representative and discuss your options. We would love to hear from you right now. Drop a comment below and tell us, have you already claimed Social Security or are you still deciding? Are you doing Roth conversions? Have you heard of QCDs before today? Your stories help other viewers feel less alone in navigating these decisions. We read every single one. Let us bring all of this together with a summary you can act on today. The most important thing to understand is this. The tax environment is changing. Rates are scheduled to rise in 2026. If you have significant money in traditional IRA or 401k accounts, the cost of doing nothing could be enormous. But you have options, and you still have time. The first step is to understand your current tax bracket. You can find this by looking at your most recent federal tax return. Your taxable income is listed on line 15 of Form 1040. Use that number to look up your bracket on the IRS tax tables at irs.gov. The second step is to speak with a fee-only financial advisor or CPA who specializes in retirement tax planning. Fee-only means they charge by the hour or by the plan, not by commission. They have no financial incentive to recommend a product. They just help you plan. You can find fee-only advisors at napife.org, which stands for the National Association of Personal Financial Advisors. The third step is to ask specifically about Roth conversions. Ask how much you could convert this year without crossing into a higher bracket. Ask whether a QCD might make sense if you plan to donate to charity. And ask how your Social Security claiming decision interacts with your tax picture. The fourth step is to act before December 31st, 2025. Roth conversions must be completed within the tax year. You cannot convert in January and apply it to the prior year. The deadline is real and it is not flexible. You have worked hard your entire life to save what you have. You deserve to keep as much of it as possible. The government has given you legitimate legal tools to protect your savings. The only question is whether you will use them before the window closes. Thank you so much for watching this video all the way through. It means more than you know. If you found this information helpful, please subscribe to this channel if you have not already. Click the like button to let us know this reached you, and share this video with someone you care about who might be facing the same situation. We are here every week with content designed specifically for people in or near retirement. Real information, real numbers, real steps you can take. No fluff, no gimmicks. We will see you in the next video. Take care of yourself and take care of your money. You have earned it.